We continue with IS 19. Defined benefit plans. This is a post-employment benefit plan other than a defined contribution plan. This plan is separate from the entity sponsoring the pension plan. What happens in this plan is that the sponsoring plan will engage the services of an actuary. The actuary will advise the entity on how much the entity needs to invest and make, based on projections and experience, the actuarial using the information provided by the entity, such as the age, the average age of the employees, the salaries, the retirement age, and other information. The actuary will advise the entity how much the entity needs to invest into the plan. The entity will record the pension plan at fair value in the liabilities, which are as the employees render their services, the employer or the entity needs to record a liability which will be recorded at present value in its books. Although the entity is managed by a third party, the entity also needs to keep a record in its books of the pension plan. We look at the measurement of the planned obligation. The standard requires the use of a projected unit credit method, which sees each period of service as giving rise to an additional unit of benefit entitlement. It measures each unit separately to build up the final liability. As the employees are rendering the service, the entity needs to recognize a liability in that period to the extent that the service has been rendered by the employee. This service is known as a current service cost. So the current service cost is the end benefits So as the employees are rendering the service, the entity is required to recognize a current service cost, which should be arrived at by discounting. This current service cost is shown as an expense in the profit and loss account. The discount rate used to is determined by reference to market yields at the end of the reporting period on high quantity corporate bonds. You will not be asked to discount these past service costs in the exams. The past service costs will be given to you already discounted in the exams, but you're required to know and explain the theoretical side of these past service costs. You are required to be able to explain what the current service costs are, how they arrived at and what kind of discount rate is used. Although when a calculative question comes, it's rare to find a question where you actually have to discount this current service costs. Now, these benefits to the employees, because they are not paid for until sometime in the future, these benefits will earn interest, and this interest is compounded back each year, reflecting the fact that the benefits are 1 year closer to settlement. So the interest costs rate will be given to you. You apply the interest on the opening balance of the obligation. This interest cost is netted off against the interest income from the planned assets. We'll look at the planned assets shortly, but you get the two interests, one on the obligation and one on the assets, net the two. If the interest on the obligation is higher than the interest on the planned asset, that goes as an expense in the P&L. Then we also have actuarial gains or losses, which may arise due to differences between the year-end actuarial valuation of the defined benefit obligation and its accounting value. Now, what happens is that the actuary will advise the entity on what they expect from their investments, what expenses will be incurred on the planned obligation. But these advices are based on experience. What might actually happen on the ground may be different. So the question will give you the opening balance of both the planned obligation and the planned asset. The question will most of the time also give you the closing balances. So once you've entered the figures for the current service costs, the interest costs, the past service costs, and whatever other adjustments the question requires you to do, if your total is not equal to the closing balance that you are given, then you have an actuarial gain or loss. The actuarial gain or loss is recognized in other comprehensive income. So the actuarial gain or loss will be computed on both the planned asset and the planned obligation. We now look at the planned asset. The entity sponsoring the pension plan will need to set aside some investments during the accounting periods to cover the pension liability. The standard requires that this investment be run by a separate legal entity, separate from the reporting entity. This investment will earn interest, which will be applied to the asset. So the interest rate given in the question, you apply it to the opening balance of the planned asset. Once you compute this interest, like we said earlier, you net it off against the interest costs on the defined benefit obligation. If the interest income is higher than the interest costs, This will be recognized in the profit and loss account. In the planned assets also, you include the contribution. As you make the contribution, you are investing. So the planned assets will be increasing with the cash contributions into the investment plan. So the entry will be to debit the fair value planned assets and to credit the cash. Just like under the planned obligation, you'll be given a closing balance on the planned asset. You also be given opening balance on the planned asset. Once you have accounted for any increases, which will be the interest, any dividends or other income derived from the planned assets, then you are going to get your total. If that total is different from the closing balance, you've got a remeasurement or an actuarial gain or loss, which you take to other comprehensive income. This gain or loss will not be reclassified to profit or loss. If it has to be written off, it has to be written off out of other comprehensive income. It is not recycled into profit or loss. Next, we look at the past service cost. The past service cost is the increase or decrease in the present value of the defined benefit obligation for employee services in a prior period. Past service costs result from either the entity making an amendment to the plan, or where there's a curtailment, which is a significant reduction by the entity in the number of employees. So take note, a plan amendment or a curtailment is a past service cost. Past service costs are recognized as an expense or income in the profit or loss account. These are recognized at the earlier of the following dates: A, when the plan amendment or curtailment occurs, or when the entity recognizes related restructuring costs or terminal benefits in accordance with IS 37 provisions.